Do you think Cathie Wood's bullish opinions on Tesla are justified, or do you share similar thoughts about the company? Cathie has always been incredibly bullish on Tesla, but how do you feel about it now? In today's video, we'll take a close look at what Tesla has going on right now and examine why investors like Cathie are so optimistic about its future. We'll also dive into potential profit projections that could help you decide on your next financial moves. So, without further ado, let's get this video started. But first, don't forget to hit that like button and subscribe to Tesla Stock News. Recently, ARK Invest made a bold claim, suggesting that the Cybertruck has the potential to become as mainstream as the Tesla Model 3. This revelation is quite remarkable and has generated a lot of excitement within the investing community. Let's take a closer look at this intriguing article. For years, analysts and auto manufacturers believed that electric vehicles, EVs, would remain a niche product. However, it appears that they were wrong about the potential of the Cybertruck. ARK Invest is challenging these low expectations and highlighting a blind spot in the industry. Many automakers currently finance the development and sales of unprofitable EVs using the profits generated from their gas-powered truck sales. If the Cybertruck were to disrupt this profitable segment, traditional automakers could find themselves in serious trouble. This isn't just a possibility, it's a near certainty. However, there is hope for some automakers, such as GM, which are now making the right moves, albeit a bit late. ARK Invest goes on to highlight how, in 2014, the U.S. Energy Information Administration, EIA, predicted that long-range electric vehicles would have little to no market share in the U.S. by 2040. Astonishingly, the market share of U.S. EVs reached 5% just last year. One would assume that the EIA must have revised their predictions significantly, possibly expecting at least a 50% market share. However, even that would still be considered bearish. It's important to note that many regions worldwide, including several states in the U.S., are planning to ban the sale of gas-powered vehicles by 2030, 2035, or 2040. These factors are significant when making predictions about the future of the automotive industry. ARK Invest has been vocal in its criticism of the forecasts provided by the EIA, suggesting that the intellect behind these predictions has eroded. They express skepticism towards the EIA's ability to accurately gauge the future of the electric vehicle market. ARK Invest also highlights the ambitious plans of legacy automakers like Ford and General Motors, GM, as evidence that the EV revolution is well underway. These traditional giants are investing heavily in electric vehicles, signaling a shift toward a more sustainable future. Such moves challenge the notion that EV adoption is just a niche trend. By emphasizing the forward-thinking strategies of companies like Ford and GM, ARK Invest aims to discredit the EIA's forecast, suggesting that these assessments fail to capture the true potential and accelerating growth of the electric vehicle market. The firm is confident that the future of transportation will be increasingly electric. For instance, Ford expects 40% to 50% of its global vehicle volume to be fully electric by 2030, while GM plans to go all-electric by 2035. I can't help but question what numbers the EIA is looking at, especially considering that several U.S. states, California alone accounts for about 13% of the entire U.S. market, are planning to ban gas-powered vehicle sales after 2035. It's clear that the EIA's predictions are flawed. Despite my apparent frustration with the EIA's forecasts, I'm quite pleased with these predictions because they present a tremendous opportunity for us as investors. Not only does the government have a slow adoption rate in mind, but there are also fund managers and retail investors who remain oblivious to the facts. While I don't believe that EV adoption will be as slow as the government agency suggests, I must acknowledge that few could be as misguided as they are. It seems the EIA has failed to grasp the concept of exponential growth, which is evident when we observe historical global patterns. Furthermore, the EIA predicts that trucks will constitute 69% of all vehicles in the U.S. by 2050, even though electric trucks are projected to have a market share of less than 10%. ARK Invest, on the other hand, disagrees with this forecast. They mention that there are already 1.5 million reservations for the Cybertruck, adding to the potential success of electric trucks. According to early Google Trends data, It appears that the Cybertruck might become as popular as the Tesla Model Y. I know relying solely on Google Trends may not be the most reliable way to predict future success, but hear me out. On April 2nd, 2023, just as Elon Musk tweeted about walking the Cybertruck production line, the number of searches for the Cybertruck on Google surpassed those for the Model Y. The search volume for the Cybertruck primarily originated from truck-loving regions, suggesting a potential desire to purchase it. The intensity of the red color on the map shows the concentration of searches in these specific areas. Ultimately, the success of the Cybertruck will largely depend on its price. If it's too expensive, sales might not reach their full potential. But if Tesla can offer a more affordable version, sales could soar. ARK Invest continues to highlight that while sell-side analysts might feel uneasy predicting exponential growth in the electric vehicle market, it would be a mistake for them to ignore the potential implications of the Cybertruck's success for traditional automakers. ARK Invest predicts that by 2027, global EV adoption could reach 70%. Although this figure may seem optimistic, it's not entirely impossible. A picture circulating on Twitter has experts discussing the quality of the Tesla Cybertruck. It's important to note that the Cybertruck is still in the prototype phase, but considering that the Model Y has become the best-selling vehicle of the year, we can reasonably assume that Tesla will maintain good quality standards going forward. Any initial concerns about quality can likely be addressed and resolved. Recently, Cathie Wood appeared on Bloomberg to discuss Tesla's focus on AI. She mentioned the autonomous taxi network that Tesla is believed to be building. Tesla possesses a significant advantage in terms of proprietary data and real-world driving miles compared to other auto and tech companies, excluding the unknowns of the Chinese market. Wood believes that the autonomous taxi platform presents a massive opportunity, with a company capable of delivering passengers from point A to point B swiftly and safely, expected to dominate the market share in the United States. Wood is confident that Tesla will be that company. Globally, this opportunity could generate trillions of dollars in revenue by 2030. This is why Wood and her team are so excited about Tesla's advancements in AI and its increasing efficiency in manufacturing, both factories and cars, through artificial intelligence. While some might view Cathie's enthusiasm for Tesla stock as overly optimistic, a closer look at her track record reveals an astonishing success rate, particularly with Tesla. I wholeheartedly agree with Cathie's viewpoints, especially her emphasis on the significance of fully self-driving technology for Tesla's future. Cathie deserves commendation for her remarkable performance in the Tesla stock market thus far. It's worth noting that Cathie's decision to not sell Tesla stock when it exceeds a 10% allocation limit has proven beneficial. Had she sold Tesla stock each time it went over that 10% threshold, her performance over the past 5 years would have been significantly worse, around negative 10%. As we examine our relationship with China during the pandemic, it's clear that we saw potential in China's monetary and fiscal policies that prompted significant investment. However, since November 2020, the situation has changed dramatically. Management teams have faced severe restrictions and regulations, leading us to reduce our exposure in China. The concept of common prosperity has emerged, which implies lower profit margins and limited services, restricted only to Tier 1 and Tier 2 cities. While we still maintain some involvement with GD Logistics and JD, we've minimized our exposure until China becomes more welcoming to international capital again. However, I believe this concern is mostly short to medium-term in nature. In the long run, Tesla's strategy to diversify its operations and establish gigafactories in various countries will gradually diminish China's significance in Tesla's operations. Moreover, even in the worst-case scenario, where tensions escalate and trade barriers arise, Chinese companies may struggle to access Western markets, while Tesla could face difficulties in selling to the Chinese market. But even if that happens, it might not be entirely detrimental.